Hey, what's up, guys? Welcome back to another exciting episode of the Punit Khatri Show. This is your host, Punit Khatri, and I'm really glad to see you guys again on the show. It means a lot that every Saturday morning you are coming in and tuning in to listen to my show. That's the Punit Khatri Show, and it is becoming a part of your Saturday morning routine. I'm very, very happy to see that. So, guys, in last episode of the Punit Khatri Show, we spoke about money management, saving money, and a lot of other things which were the basics of personal finance and money management. In this episode, we are going to talk about those things, or we are going to take those things a little ahead. In this episode, we are going to talk about the investment. So, what is investment? How can you go ahead and invest your money? What are the types of investment options available? And also, at last, what are the best investment options available in India for you to invest your money in 2019? So, I'm pretty excited to walk you guys through all of these options and everything about investment. Are you guys excited on a Saturday morning to talk about your money investment options? I hope so. You're pretty excited about that. So, guys, let's start with what is an investment. So, investment is when you go ahead and have some extra money and you put it somewhere, or you give it to someone who is utilizing that money and giving you a return on that money. You can say your money is working for itself, your money is working for you, and you don't have to work for money, or you don't have to do anything in order to grow that chunk of money that you're investing. That is exactly what investment means. I did not give you a direct definition, I just made you understand what an investment option is, or what an investment is. Now let's talk about types of investments. But the very first thing that I want to talk about is savings bank account. Because many people, what they do is that they save money, but there's no money in saving. Actually, you're not doing anything. Your money is not working for itself. Your money is not working for you. Why? I'll tell you that. Most of the people, they choose either of these two options. First is cash in hand. The second one is a savings bank account to save their money. Cash in hand is an option wherein your money is sitting in a cupboard in your house, and no one is actually utilizing your money. You are not utilizing your money, and it's just sitting idle. And that is the worst thing you can do to money, or that is the worst thing you can do with your savings, because it really doesn't make sense money just sitting in a cupboard, because there are a lot of people in this world who are looking to get money, and they'll pay you a really good amount of interest on that money. So why you want to just keep that money in your cupboard? It really doesn't make sense for you to keep it in your cupboard and just let it be idle. You need to ensure that your money is working for itself. Your money is growing on its own without you taking any efforts on your part. That is exactly when you can call this or any of the option as an investment. Cash in hand is not at all recommended from my side. Talking about savings bank account. So I guess many people, they choose just like it's an alternative for cash in hand, because managing cash is also sometimes very difficult. So you can just keep it in your bank account and it's just sitting there, and you think your bank is paying you somewhere between 4 to 6% per annum. That's what average rate of interest on savings bank account in India is. But 4 to 6%, let me be very honest, is very negligible rate of return. It's almost like your money is not doing anything. It's going to take around like 9 to 10 years for money to get doubled. Why do you want to spend that much time for money to get doubled? You need to choose an option. You need to select an investment option wherein your money is getting doubled as soon as possible at the least time frame. That is when you are able to choose, or you are choosing the best investment option. So let's talk about types of investments now. So you now know that if you have some money, you have saved some amount of money, you have savings, you are not supposed to keep it in cash in hand or in your savings bank account. You need to get it out from there and put it somewhere else wherein it is able to grow at a faster pace. It is able to do a lot more work than you're actually allowing it to do right now. That is why we are going to move ahead by talking about types of investments. What are the different types of investment options available for you to invest your money in 2019 in India? This is a list of total 10 investment options. I'm going to I'll just tell you the points and then we'll discuss each one of them further ahead. The very first one is direct equity investment, mutual funds. Then we have post office saving schemes, we have public provident fund, we have fixed deposits, we have IPO listing gains, RBI bonds, real estate, gold, and insurance plans. So these are total 10 of the investment options that you can choose your money to invest in. And now let's discuss each one of them in detail so that you can get a pretty good idea about where your money should be sitting. So guys, let's go ahead and firstly talk about direct equity investments. So you know that you can go ahead and buy shares of every listed company in India. So you can go ahead and buy shares of Reliance, you can buy HDFC Bank, HDFC or DLF, DHFL, or any of these companies which are listed on the stock market for that matter of fact. I do not recommend any of the companies which I just mentioned a while ago. So ensure it's just an example. So what happens in direct equity investment is that you are becoming a part owner of the business. So suppose if tomorrow you're buying a Reliance share. So as of today, when I'm recording this podcast, the price is approximately 1300 rupees. And if you're suppose buying 10 shares of Reliance or like 100 shares of Reliance, you are a part of Reliance Industries, you are a partial owner of Reliance Industries. And whatever gains you get from the company, if the company's business is growing, if the company's clients are going, performance is growing up over the years, your investment also grows because the company is using your money to work. And then if there is any growth, if there is any future potential, then all the advantage benefits is what you are getting. When you invest in a direct equity investment, there are two types of benefits that you gain. First is the capital appreciation. So when your stock price moves from 1300 to 2000, for every stock that you own, you're making 700 rupees profit. That is the very first profit. Second form of investment return that you're getting on direct equity investment is the dividend. So what happens is every year when Reliance goes ahead and creates its annual balance sheet, annual profit and loss statement, everything is created. After all the expenses, whatever money is left, the profit that is left, and some part of which is sent to retain earnings for future prospect requirements, and the remaining chunk is divided among the shareholders. So that remaining profit which you get is also known as dividend, and that is the second form of income return that you're getting from direct equity investments. But you need to make sure something. You should be good with analyzing companies. You should be good at studying their charts, patterns, fundamental analysis, their book records, cash flow statements, and a lot of these statements you need to be properly able to analyze them in order to make a good decision. Also guys, one more thing I'll recommend you, that if you're confident enough with the company, then only go ahead and invest. Otherwise, if you become emotional, you are going to lose money. That is what generally happens. So in direct equity investment, there are two options. If you're willing to buy stocks of any company, there are two options. The first is the primary market, second is the secondary market. Primary market is an IPO. So as you might have heard about the IRCTC IPO that is being rolled out, or the issue bidding has already been closed. So this is the primary market. If you want to have a direct equity investment in IRCTC, you can go ahead and apply for the IPO and wait until the company is doing pretty good and there is a pretty good return, because direct equity investments required a long term investment period. So if you do not have a long term time frame, then I would not prefer you to have investments in direct equity investments. Second option where you can go ahead and buy shares from is a stock exchange. The shares that you buy from a stock exchange are the secondary market shares. So someone is already holding Reliance shares and they want to sell their shares and you want to buy, so definitely you will be going ahead and buying shares from the person who wants to sell shares. That is how the stock market functioning works. So guys, now let's talk about the second investment option, that is mutual funds. So in case you do not have an idea about what mutual funds are, let me just explain you. In case you want to invest in the share market, you want to invest in the equity market, or you want to invest in the debt market, but you do not have time or you do not have proper knowledge and requirements to analyze where you should be making your investment, well, this is the case wherein you should be investing in mutual funds, because there are companies known as asset management companies. These companies are formed just to manage the money from people. So they take money from you and they have analysts, they have people who do a lot of study work, they do analysis work and all of that. After doing a proper research, these people go ahead and invest in the stock market. So this is how they are making a right decision on your part. You do not have to make any decision, you do not have to do anything, you just have to give your money to the asset management company. They'll be doing all the research, every single thing that is required, and investing your money on your behalf. In return, these are pretty similar to equity investments. So whatever return or dividend they get, they distribute it among the shareholders. So how much ever mutual fund share you are owning, the profit you will be getting out of it. And to do all of this process, asset management companies charge commission. So you need to ensure and find a pretty good investment scheme or the mutual fund scheme wherein you have to pay less commission and the past performance is pretty good. So after analyzing 2-3 things, you can go ahead and invest your money in a mutual fund scheme. Also, there are types of mutual funds. So it's just not that there are mutual funds, but there are different types of mutual funds. So there are in major talking about three mutual fund types: equity mutual funds, debt mutual funds, and hybrid mutual funds. So if you opt for equity mutual fund, what happens is that the asset management company will only be investing your money in equity shares. If you talk about debt mutual funds, then you might know about debt, non-convertible debentures, convertible debentures, or any other form of debt wherein the company is willing to raise money. Your money will be invested in those markets and you get a fixed rate of interest from there or fixed return from there. When talking about hybrid, so this is a special kind of mutual fund wherein half or a risk to reward ratio, the asset management company divides how much to invest in equity, how much to invest in debt, and makes an hybrid fund accordingly. So definitely you can go ahead and choose mutual funds as an investment option if you do not have proper time, or if you do not want to go ahead into research and analysis. Definitely just go ahead and put your money in a mutual fund scheme, and the asset management companies will be doing every single thing for you on your behalf. Also guys, moving up to the third option that we are going to talk about today, that is the post office saving schemes. So if you aren't aware about the post office saving schemes, these are saving schemes which are promoted by the central government of India. So the risk is very negligible in these schemes. So that's why when the risk is low and the return is good, it makes it a very favorable investment option for you. Under post office saving schemes, you have various other options as well. So these are national saving schemes, recurring deposits, senior citizen saving schemes, and lot more other options. So if you want to know which saving schemes you want to invest in, you can definitely approach a post office and you can talk over there, and they'll be explaining you every single detail about these things. Or you can search it over the internet as well. Then you can choose which post office saving schemes you want to invest your money in. But the main part over here is that the risk is very low, the return is pretty good, and that's why it makes it a very decent option for you to invest your money in. Also guys, moving up to the fourth option for the types of investment, we are talking about public provident funds. So these are also known as PPFs, wherein these are the safest investment option or best tax saving investments that you can do. There is a guarantee by central government because it is being managed by central government, and the returns that you can earn are pretty good on that. So if you wish to go ahead and open a PPF account, then you can go to a post office, or you can do that from your Demat account as well. And you can invest around 500 to 1,50,000 per annum. So then also here also the government is giving you option if you want to invest the entire chunk of amount in one go, or you want to invest that in 12 different installments. So every single month some certain amount of money will be debited from your account and will be credited into your PPF account. Government will be using that fund and paying you interest. But one thing that you need to keep in mind when you're choosing PPF is that it has a locking period of 15 years, which means for next 15 years you won't be having access to your funds. You just need to invest, and you don't get any of those funds in return, you just get the interest return. PPFs are able to earn an 8 to 10% of interest on them. So that's a pretty fair enough interest, because the interest rate over here is pretty attractive. Government is being using your money, and that's why there is a negligible risk involved over here, and the return is pretty good. Also, when you invest your money in PPF, you get a triple E tax benefit. How is that? The investment amount that you're investing, you're not charged tax on that. The interest that you earn on your PPF account is also tax free, and the maturity amount that you get after 15 years is also tax free. So if you're looking at tax benefit investment options, PPF can be your choice, and this is again an investment option wherein the risk is negligible and the returns are fair enough. Now let's talk about fixed deposits. So until now, I guess you would only be aware about bank fixed deposit, that you can go and approach to any of the banks and they can take your money and provide you a fixed rate of interest on them. But there are also company fixed deposits. So these corporate companies wherein they want to raise funds, and they want it for like a short term or a long term period depending upon the time frame of the fixed deposit. You can also have a fixed deposit with them as well. But there is a lot of difference between a company fixed deposit and a bank fixed deposit. Let me explain you. So in a bank fixed deposit, what happens is that banks borrow money from you. They can be for around like 20 days, 15 days, or range up to 5 to 10 years as well. So when you have a fixed deposit with your banks, what happens is that suppose you have a fixed deposit for a maturity period of 5 years, but you want to like get your money out of that. You have an emergency requirement. In that case, what you have to do is that you can go ahead and approach your bank, and within like 2 years, 3 years, or whatever time frame you want to break your FD, you can go ahead and do that. Bank will charge you a fees for that, but that is also negligible amount and fair enough amount. But in case of company deposit, if your maturity is 5 years, you can't get your money out even at 4.5 years also. You need to wait for the entire maturity amount, and only then you will be able to have access to your funds, or you will be able to get your money back. So that is why you need to decide your maturity amount very carefully. Apart from that, guys, also the major difference here is that bank fixed deposits are RBI regulated. So RBI is taking a check on that. RBI is regulating these funds, but company fixed deposits are not recorded by RBI. They are not regulated by RBI. That is why the risk on the company fixed deposits is a little higher as compared to bank fixed deposit. But that is also a reason why the bank fixed deposits do not pay you a higher interest, and the company fixed deposit will be paying you a little higher interest as compared to bank deposits. Moving up next, guys, let's talk about IPO listing gain. This is one of the favorite investment options, and also, like, if you are 17, 18 years old or 20 years old, you can also go ahead and do this investment option, and it's pretty fair enough, but you require a lot of research. What happens is that when an IPO bidding starts, so IPO means initial public offer, which means that the current share of the company, suppose let's take an example of IRCTC, which is the freshly bid completed IPO. So IRCTC wants to issue shares to the public, so they will go ahead and start the share listing process with an initial public offer. That is the very first time wherein the company is offering shares to the general public, and people can come ahead and subscribe or make a bidding for that IPO, and they can go ahead and get the shares before the company is listed on the stock exchange. Now what happens is that, if you might have read about the IRCTC IPO, the bid price was ranging somewhere around 250 to 300 rupees, I guess, if I'm not wrong. I'm not very sure about this thing, but let's take an example of the bid pricing for an IPO is 250 to 300 rupees. All right, so which means that you might be getting your shares at somewhere between 250 to 300 rupees. This is the price band of your IPO. Now what happens is that this is not the same price wherein the company will be listed on stock exchange. Suppose on Monday, when the stock market opens, the company is getting listed on the stock exchange, and you will be able to go ahead and trade the shares on the stock exchange as well. What happens at that time is that, suppose your 250 300 price band share, if it is overly subscribed, there is a possibility that it might list on the stock exchange at the very first day for around 450 to 500 rupees. That is a possibility. Not all the IPOs are such, but you need to find the best IPO, or you need to find that IPO for yourself wherein such scenario can happen. So you guys, what happens is that you got your stock between 250 to 300. So let's take an example that you got the shares for 250 rupees, and the listing on the stock exchange is for 450 rupees. Then on the very first day of listing, you're getting a 200 rupee benefit on every single share that you bid it for. Now what you can do is that you can choose either to hold this for a long term, or you can sell it on the very first day of trading as well. So when we go ahead and sell it for the very first day of trading, this is known as IPO listing gain. So when the IPO is listed on the stock market, you're getting a gain from that, and that is exactly what this investment option is about. Average investment amount for an IPO listing or an IPO bidding is ranging between 12 to 15,000 rupees. So if you're investing, suppose 12 to 15,000 rupees, and you're getting 200 rupees gain on every single IPO or every single share, that's a pretty good investment. You can easily convert your 12,000 into 20,000 in one single day. That is how you need to go ahead and study IPOs, study companies, and make that investment decision wherein the IPO listing can be gaining and beneficial for you. Now guys, let's go ahead and talk about the seventh investment option, and this is known as RBI bonds. So whenever government wants to raise money from the general public, what it does is that it requests the RBI to raise funds on government's behalf. RBI will issue bonds on behalf of government and issue it to the general public, like people like you and me, and it will collect all the money from you and me or the general public and give it to the government. It acts as a mediator for the government for issuing such bonds, wherein these bonds are very safe, and also government is using your money. So in no matter what happens, your money is very safe, and it is actually in safe hands. And that is exactly why the interest rate is also a little lower side on these bonds. Guys, you need to know one thing, man. Whenever your investment risk is lower, the return will be lower. Whenever you take a huge risk, that is the time when you get a huge return as well. So you need to consider that in mind. And also RBI bonds can be a good option for you. The investment period depends upon like which bond you're investing in. They can be ranging around like 5 to 7 years. That is a locking period, but few bonds are also listed on the stock exchange. So you can sell your bonds or you can buy bonds on stock market as well. So you need to study on that, and you need to do a little bit of research to find the best RBI bond that you can invest in. Now let's move ahead and talk about real estate. So guys, real estate is an industry in India which is also known as money making industry, because on average the return that you can get on your real estate property is ranging somewhere between 30 to 100%. But for that also you need to do a good amount of research, which area is good, which projects are coming around which area, and where you should be buying a property, or like which type of property you should be buying. These are a lot of areas of, or the factors that are involved in how much return you can make from your investments. So you need to study on that as well. So basic what happens in real estate is that you buy a property at a lower price. Suppose you buy a piece of land for like 50 lakh rupees. After a year or two you are able to sell that land somewhere ranging between 75 lakh rupees. Then that is also known as your capital gain. So you buy at a lower price and you sell at a higher price. That is how the real estate market works. But ensure that you're making a proper research before investing in any sort of property. So guys, moving up next, let's talk about gold. So gold is an evergreen investment. Whatever happens, you can anytime, like with blindfolded eyes, you can go ahead and invest money in gold, because gold has just appreciated over the years. If you just see a chart of gold appreciation since 1947, you'll be shocked, because the return that gold has provided has been immensely successful. People have like made millions of rupees by just investing money in gold. So that is exactly why gold becomes a very favorable investment option. The risk is very low and the returns are pretty good. That is the exact reason why gold is a pretty attractive investment option as well. There are different ways you can invest in gold. So you can buy your gold deposit schemes, you can buy gold ETF funds, you can buy a gold bar or gold biscuit from the market, or you can also buy gold mutual funds. So let me talk about gold deposit schemes. So this is what the government of India issued in 2015 budget, wherein they started the gold deposit schemes, wherein an individual can give government a gold of approximately 200 grams and get gold bonds in return on that. And the interest that government was giving on that gold bonds was 3 to 5% per annum. So you get double benefit over here. You're getting interest on your gold, as well as you're getting the gold price appreciation benefit also. So there is a capital gain, there is an interest gain also. But the problem here was the locking period is somewhere between 3 to 7 years. So for 3 to 7 years, you will not be having access to your gold. It will be with government, and in return, you will be having the gold bonds in your hand. That is how you need to go ahead and think about if gold can be your investment option, if you can go ahead and invest your money in gold. Also guys, one more benefit in gold is that there's no tax charged on gold. For investment, there's no tax. If you go ahead and buy gold jewelry, definitely you'll have to pay tax on that. There's also one plus point for gold investment, that is tax benefit. So guys, let's go ahead now and talk about the 10th best investment option for you to invest your money, and that is insurance plans. So there are a lot of variety of investment plans available in the market. There is assurance policy, there is life insurance policy or whole life policy, joint life policy. You need to get in touch with an insurance agent to discuss which policy is best for you. But insurance is a pretty good option for investment, because what happens here is that the company or the insurance company is sharing the risk of uncertainty, and in return you're paying the company a premium amount which could be negligible, or a certain amount of premium every single month over the years. And in return you get, like when you are invested for a long term, you get a moderate return as well. In case of loss of life, of property or anything else, also you get return from investment companies, and these investments can be pretty attractive only in case of long terms, but definitely the returns are not as high as any other option that we have already discussed. So yeah, insurance policy is something which you should definitely be investing in, but definitely you need to consult your insurance agent before moving ahead and making your investment in an insurance plan. So guys, these were the top 10 investment options that you could go ahead and invest your money in 2019. Also, I want to know like which is the investment option that you are choosing and going to invest your money in. Let me know in the feedbacks that you will be providing me. Also, you can connect with me personally in case you want to invest some amount and you are unable to figure out how to go ahead and do that, or how to diversify your portfolio. Definitely you can get in touch with me on the social networks. Everything will be listed on the website link that is listed in the description, or you can write me an email at hello@punitkhatri.in, and I'll be really happy and glad to help you guys to prepare your portfolio, your investment plan. So guys, that's about it, and now we should sum up the second episode of the Punit Khatri Show. I'm really happy that you guys tuned in for listening to me. Guys, if you are enjoying this series, definitely go ahead and rate us, and please provide me feedbacks, any areas of improvement. Any feedback is very, very appreciated. I want to improve myself as well, and I'm really glad to see that you guys are also consistent and committed towards your improvement in the field of personal finance with Punit Khatri. Hope you guys enjoyed it, and definitely, guys, I'll be hoping for you to watch in and tune in next week, next Saturday morning, for the third episode. There are a lot of surprises and a lot of new content coming up in, so I really want you guys to stay tuned. Bye bye.